change either way. It was very much, I would say, as expected. I think one takeaway that I came away with about 15 minutes in, Sarah, was he talked about maybe not needing as many of those jobs back. I think that was the first time I heard him say that. So I think the Fed's a little scared that technology and the adoption of a lot of technologies during the pandemic and the success of companies in sectors that had invested in technology relative to those that hadn't might mean that some of those service sector jobs, those 8.5 million we still need, could be a little more difficult to get. And I thought that was the most interesting thing I heard from him today, a little bit of skepticism. Usually he's been a lot more optimistic on getting those jobs back, and I didn't hear that as much today. So I thought
it's a luscious green lawn you're sitting on there, by the way, David.
Looks like we're interrupting your tanning.
Yeah, or your gardening.
I hang outside all day doing my Zooms. I figured I might as well do them with you guys, too. It's nice.
Very nice indeed.
I'm back up in the New York area. It's beautiful, 70s up here. So.
I know. Well, I'm envious you're outside. We must get back to the topic at hand, David. What are you advising your clients to do at the moment in terms of positioning? Does today's meeting mean you kind of continue more of the same of believing stocks go higher? I think you don't want them to hedge at all, though, with any kind of offsetting bond position. Is that right?
Correct. Yeah, we're not advocating our usual risk parity. We still think bond yields have a little bit more to run, up toward the 2% or possibly a little bit more by the end of the year, especially as Europe reopens and maybe the European fixed income markets have a little bit of a weakness because of that. But I think it's just, Janet and Jay, those are our hedges. If something goes wrong, I really do believe they're going to step in very quickly and they're going to be very proactive with policy measures that will soothe any market hiccup. So rather than have the fixed income be our hedge, because it's so expensive and the yields are so low, we're just we call them the Jays, Janet and Jay. So it's SPOOs and Jays. That's been our trade all year. It's run rate, it's up 12% for the year. And run rating at over 30 or 35%. I kind of still like it. We're here in almost May and I still like it.
David, we are out of time.
You look like you like it.
Thank you, as always, for joining us. David Zervos.
Shepard Smith here. Thanks for watching CNBC on YouTube.